organizations. So I'll just write the acronym and then maybe you can guess which one is correct. So you have a BBA and you have a ICE. So have you heard these terms before? So BBA stands for British Bankers Association and ICE stands for Intercontinental Exchange. So were these introduced as a part of maybe your financial institutions or financial markets class? Okay. So LIBOR up till now. So when I say up till now, not exactly up till now, maybe till 2014 or 2012, 20, around 2013, 2014. So right from its inception, right up till 2012, 2013, uh, BBA was responsible for publishing LIBOR on a daily basis. Now, this is a rate which comes on a daily basis. So someone has to be responsible for doing that. So BBA was responsible for publishing this LIBOR on a daily basis. But later on, this responsibility was moved to ICE. So there are a few reasons as to why this happened as well. So we'll talk about that. But now it is ICE or Intercontinental Exchange which publishes LIBOR on a daily basis, on a day-to-day basis. So firstly, how exactly the LIBOR rate is calculated? So LIBOR firstly is published for a variety of currencies. So you definitely have it for five major currencies. So you have it for USD, you have it for Euro, you have it for pounds, you have it for Swiss francs, and we have it for yen. And along with that, there are a few other currencies as well. But these are the five main currency regions, as we call it. So we'll talk about these. And for all of these currencies, a LIBOR rate or LIBOR curve used to be quoted on a daily basis. So maybe let's focus on USD LIBOR for now. So when I say USD LIBOR, imagine that I am talking of, let's say, a LIBOR curve. So let's take a few tenors. So maybe I have 1M, 3M, and 6M. So maybe I'm focusing on the 3M part. Now, let's say I want to focus on USD 3 months. And once you say 3 months, the same idea will be applicable for 1 month, 6 months, 9 months, etc. So for those respective tenors, also the same approach will follow. So maybe we can discuss about USD 3M now. So let's say ICE wants to publish USD 3M today. So how exactly that happens is there is a certain set of banks which we call as panel banks or panel of banks. And panel of banks are large global banks which are very, very active in the global FX and interest rates market. So people like Goldman Sachs, Morgan Stanley, Bank of America, JPM, etc. So if I recollect, about 8 or 10 is the total panel size. So these banks submit their quotation for 3 month LIBOR. Now here we are specifically talking of 3 months. The same discussion you can apply for 1M and 6M as well, but keeping it specific. So every bank in this group is going to submit their quotation for 3 month LIBOR or 3 month USD LIBOR. That is, they say that this is our estimate as to what the 3 month USD LIBOR is going to be today. Now all these submissions are done to ICE. Now, once ICE receives all of these submissions, it is going to remove the outliers and then it is going to publish what is the 3 month LIBOR as of that day. And that is what you call as the LIBOR fixing for that day. So this happens every day in the morning. Once the quotations are received, ICE is going to remove outliers and publish the rate for every single tenor for every single currency. So here we spoke of 3 months. The same discussion can be applied for 1M, 6M, 9M for USD LIBOR. Same thing can be applied for Euro, GBP, CHF, and JPY as well. So that way we have a new LIBOR fixing which is available every day in the morning. And this is also what you call as the LIBOR rates curve as of that day. So is this idea okay? So just like USD Libor, you have a Euro Libor, GBP Libor, and so on. Now this was the process which was followed for close to 2 to 2.5 decades. Now that was when the market was struck with a Libor rigging scandal. So when I say Libor rigging scandal, that has to do with the nature of Libor rates. So when I say nature of the Libor rates, the the way in which these rates are made available to the market, I would say. So firstly, Libor rates which are quoted by these banks, these are non-traded, because these, as I mentioned, these are estimates which the banks have given or the panel banks have given. So these are non-traded and they are non-binding on them. Now, these are the two main reasons which led to the Libor rigging scandal. So a few years back, we had a Libor rigging scandal which had happened roughly around 2010, or I think around maybe 2011, 2012. So there was a large-scale rigging scandal which happened, and the reason for that was uh, there were a few traders in these panel banks who had colluded, and they decided to quote those Libor rates which are favorable for their portfolios or their positions, and not really a fair representation of interest rates. Now that is plain rigging, isn't it? Because these panel banks who have a say on what the Libor is going to be, a certain set of traders have gone rogue, and they have started quoting those rates which are favorable for their portfolio positions, and they may be detrimental to the broader market. Now that is something which was brought to light a few years back. So that's what we call as the Libor rigging scandal. So that was when, or maybe that is the time which got the market thinking as to the stability of Libor. Now, why I say stability and credibility? Because something which is non-traded. Now, when I say a non-traded rate, that means these rates are simply quoted. You may not have an actual transaction which happens at that rate. Also, at the same time, they are non-binding in nature. So maybe one of the panel banks may quote one value for Libor, but they may actually trade at some other rate. That is, whatever rate they quote is non-binding. So that way, the Libor rate was non-traded and non-binding in nature, which basically uh, opened up a chance of rigging that rate, which was definitely done by a few set of traders. Of course, now subsequently there were legal proceedings. Those banks were fined, those traders were fired, etc. That followed. But in that confusion, the market lost confidence in Libor, or the market realized that the credibility of Libor is something which is questionable. Of course, post the scandal, there were additional checks and balances which were introduced. So that way, the market participants knew that something like this can happen. So they also became careful to the way in which rates were quoted, and banks also started following certain set of procedures or safeguards, which would deter any kind of rigging to happen. But naturally, something which has happened in the past can repeat, isn't it? As we say, history repeats. So there was always a possibility that Libor rigging can again happen in the future. Now, that is something which the market and regulators wanted to avoid, because once a certain rate is rigged, that means it's not really a fair rate, or it's not really the true representation of interest rates in the market. So after this rigging scandal, the market got thinking that what could be the alternative approaches to Libor. So that is when the a global exercise towards figuring out what could be an alternative benchmarks which could be offered in place of Libor, that gained steam, and that is when we started thinking about newer benchmarks to be used. And this is what you call as the idea of Libor transition. So any questions up till now?
Yes, sir.
Okay.
So then, sir, which benchmark is being used now, if not LIBOR?
Yeah. So we'll talk about that. So we'll just complete one more point and then we'll come to that.
Sir, can you explain that about
Yeah, sure. Please go
non-binding
ahead.
here again? Like how is it non-binding?
Yeah. Yes. Yeah. Yeah. So when you say something is non-binding, that basically implies that the bank has full flexibility as to whether they want to do the actual trade at the Libor which they have quoted, or they want to do it at something else. So the bank may quote X percent as Libor, but that X% is not binding on the market, binding on that particular bank. So the bank may say X%, but the actual transaction which they do with someone in the market could be at Y%, where X is not equal to Y. So that means although they have quoted X%, it is not binding on them that they have to trade at X%. They may decide to trade at Y% as well. So that way, that brings in a kind of discrepancy, isn't it? So that's why we say this is a non-binding quote, and that was one of the drawbacks for Libor.
Okay, sir.
Now, before we go to the alternative benchmarks, understanding why Libor was so important, because it, as I mentioned, it was important both in your cash as well as derivative segment. So in the cash segment, you could have, let's say, a floating rate note or a floating rate bond, whereby the coupon on the bond is linked to Libor. So that way, as the Libor rates change, your overall floating coupon will keep on changing. And in derivatives, you could have maybe an interest rate swap. So a swap could have this as the benchmark. So that way, your floating leg cash flows will also get impacted based on the way in which your Libor rates are moving. So that way, your derivatives market can also get impacted. So so that way, if you see, especially from a derivatives point of view, there are trillions dollars worth of notional contracts globally which are dependent on this single benchmark Libor. Now that way you can imagine what could be the impact. Whenever you are having a rigged rate, then it will have a large scale repercussion on the entire system, because everyone has some position in Libor or Libor related products which they are holding. So that is something which is risky, because you are having an unfair rate which is being quoted, or something which is not a true representative of the market rate, and still you continue to benchmark your products onto those rates. So that's why, and the market decided to move on to a new set of benchmarks. So now new set of benchmarks are these overnight benchmarks, or overnight rates as we call it. So USD has decided to transition to SOFR. Euro has decided to transition to Ester. GBP has decided to transition to Sonia. CHF has decided to transition to Saron, if I recollect correctly. JPY is Tona. Now, these are the new set of benchmarks currency-wise, whereby transition is going to happen. Now, the gaps which we have seen in Libor are something which we are trying to make up in these new benchmarks. So, firstly, these will be traded rates. That is, whatever transactions happen, let's say I talk of USD. So, whatever transactions happen on SOFR, those are something which will be used for, or those are the actual rates which will be used in deciding on the SOFR benchmark. That is, you have traded quotations from market participants which will be consumed. So this is the advantage, because now you have a traded number. Now something which is traded cannot be rigged, and also it is binding because you have already done the trade on that, right? Now something which has got traded, you simply don't have any way of rigging that trade. So that way it is free from any kind of chances of rigging. So these are a couple of advantages for these new benchmarks, and all of them follow more or less a similar logic. So all of these are going to be traded, and these are non-riggable rates, I would say, because once you have a traded quote, you cannot rig it. And these are the new benchmarks which we intend to use going ahead. So from 1st of January, Libor rates have ceased to exist for all of the other currencies except USD. So Euro, GBP, CHF, JPY, everyone has transitioned away from Libor onto these newer benchmarks. For USD, I think for up till 2023, I think 2023 June or something. So until then, majority of the tenors in USD Libor are will continue to be get quoted, and after that, we will completely switch to SOFR. So that is the transition which has happened. Now, also, gradually volumes are building up on these new benchmarks as well, because volumes are equally important, right? Without having volume, we'll not be able to have the efficient rates at which the market can trade. So volumes have also started building up, and always a greater volume will give you better price efficiency, and that way your rate discovery will be much better. So that has also begun. So now banks are also advising their clients that whatever new transactions they do, they should switch or they should use these new benchmarks. They should not use LIBORs anymore. So that way, market has begun adopting these new benchmarks in a big way. So this is from your trading book side. Even your banking book has gone in for a transition. So when I say a banking book, it is products like your loans or maybe overdrafts, etc. Now all of these are now you may have a floating rate loan which is linked to LIBOR. So now that will also go in for a transition because now LIBOR doesn't exist anymore. Now your loan will have to be marked with a newer benchmark, maybe something like Esther. So that way, there is a ARRC, which we call as the Alternative Reference Rates Committee. So ARRC is like a global organization which was set up by the industry and regulators together so that they come up with guidelines and best practices to be adopted for usage of these newer benchmarks into practice. So even the daily accruals on loans, ODs, etc., something which was done via LIBOR, that will switch to these overnight ones. So maybe if I have a loan which is in euros, I'll not do the loan on euro LIBOR anymore. I'll do it on maybe Ester. So that way, that calculation methodology changes. So my daily loan accrual also changes because my methodology has changed. I don't use LIBOR anymore, but I have decided to use a overnight rate. So that way, most banks have a certain calculator which is going to handle these kind of changes in calculations. And that way, you have a new model for handling all of your banking book products as well. So that way, your banking as well as trading books have gone in for a transition, or the way in which they were built, that is getting transition. So maybe all of your earlier systems might have to be revamped as well to handle all of these incoming benchmarks. Now, role of regulators and global setting organizations. Now, they play an important role whenever it comes to maybe adoption of these new benchmarks. That is because finally you require support from regulatory organizations and also you require someone to have best practices to be set. So people like maybe ISO standards, etc. All of these play a role in giving out best practices. So along with regulatory guidelines, if we combine them with best practices, they help us streamline the process in a certain way. So that's how regulators as well as global standard setting organizations are also contributing their bits in order to streamline this process of benchmark transition. So this transition has already happened. So by the time you join your respective offices, you'll have these things which will be direct, which may already be in place, or they may be, or maybe they're getting into place now. Now, this overall process of reforms, I would say, has both pluses and minuses. So challenges and opportunities. Now, challenges uh, because now we are trying to transition something which is into maybe we're transitioning onto something new. Now, LIBOR is something which is ingrained into the system because something which has been around for decades. So now all of your systems and all of your models are tuned to LIBOR. But that is going to change now because now we have a new set of benchmarks which have to be adopted. So that way your systems have to be tuned, your models have to be maybe revamped in order to handle these new benchmarks coming in. So maybe making such a large scale transition in the system and for individual market participants, that can be a challenge. But these challenges also pose opportunities. And when I say opportunities, especially from a jobs perspective, because whenever you have these kind of transitions which happen, now these transitions do not happen every now and then. Now for the foreseeable future, we do not expect these interest rates benchmarks to change. So that way, from an opportunity perspective, you require people who understand this transition, who understand the new benchmarks, who may be tech savvy in order to enable banks or financial institutions to transition their tech infrastructure or maybe their financial infrastructure onto these new benchmarks. So all of these can be visualized as maybe opportunities, which one can look at. So this is how I would like to put opportunities and challenges for this overall reforms process. So any questions on this?
I have a question. So, like you said, banks are now moving away from LIBOR to several different benchmarks, right?
Mhm.
But then eventually, I imagine the way these benchmarks are calculated is going to be similar to LIBOR again. What are the safeguards against rigging in these benchmarks?
So what the market is trying to do is Now again, the advantage is we'll be using traded rates. So I think traded rates is the biggest safeguard which is going to ensure to a significant extent that rigged rates do not come in. So once you have a traded quote which is being used, your chances of rigging vanish, and that way you will have a fair representation of the rates which are prevailing in the market, and that can be one of the important safeguards, or I would say advantages of these new benchmarks.
So when you say traded rates, you mean swaps basically, right? The rate at which swaps are being traded.
So not just swaps, but you will have cash products. So you'll have anything in the shorter term up till 1 year. You could have, let's say, SOFR futures or maybe FRAs, which are done on them.
Okay.
We'll talk a bit about FRAs also and swaps. So that way we
Okay,
can
sure.
have the entire curve which can be used in our calculation. Now, advantages
Okay.
for your banking book, you don't have to worry about anything else. For banking book, simple cash market is good enough. But naturally, you have a derivatives market which is bigger. So that's where building liquidity on futures and swaps is important.
Okay, and so one more question. Now, although different countries have moved away from LIBOR, London still remains a major financial hub, right? So a significant amount of fundraising is still going to happen from London. So if I'm raising from London, am I like, is it compulsory for me to use LIBOR, or can I still use another rate from London?
So that depends. Now, in case, let's say you are a part of a company which is going for a fundraising activity, then you may decide to use whichever benchmark you feel right. So maybe you may want to optimize your costs in the best way possible. So whether you want to do it at these newer benchmarks, or maybe is there any local benchmark in London which you would like to use for raising funds? I think that would be a very subjective discussion. So
Okay,
it's
okay.
hard to answer that hard to answer it in one single way. Yeah.
Okay, sir, got it.
Any more questions on this? Okay. All right. So this completes our discussion on fixed income assets. So any questions up to what all things we have discussed in fixed income up till now? So anything from the last week, the last entire week we have spent on fixed income. So any questions on that? Or any section which you want me to repeat, because a few concepts which we studied there are going to be used ahead. So especially idea of spot rates and implied forwards. This is something which we are going to require as a part of our discussion on FRAs or forward rate agreements. So any questions for anyone? Okay. Now let's talk of FRAs or forward rate agreements. So we'll also see the relevance of FRAs subsequently. So when we talk of applications of FRAs, we'll see how exactly FRAs are relevant in practice as well. But the meaning of FRA is this is a product which will allow you to make an estimation of what could be the interest rate at a certain point in time in the future, or basically it will allow you to estimate what could be the forward rate standing today. Now I say an estimation because standing today, I don't know with certainty whether a certain rate is going to be realized in the future. But looking at the current LIBOR, maybe not LIBOR, but any other term structure, maybe looking at any floating rate term structure, I may want to estimate what could be the forward rate at a certain point in time in the future. So maybe I can have a certain timeline. So standing today, I may want to estimate what is the 1 year forward rate 1 year from now. So same idea as the implied forwards which we have discussed earlier. So that is here, standing on this red arrow, I want to figure out what could be the 1 year rate after 1 year. That is basically standing on this point. I would want to compare whether I am right or wrong. So let's say I decide on a rate of X%. So let's say this is my estimate standing today. Now, imagine that I have moved 1 year ahead and I'm standing on this dashed or maybe this starred arrow. And now the rate is Y%. which is the realized rate, because now y% is the actual rate which is prevailing on 1 year time point, right? Because I'm standing here. So now I don't have to estimate anymore. I have the actual rate which the market is quoting. So then I can compare X% versus Y% and then see whether my estimates was wrong or right. And based on that, my overall payoff on this FRA contract will change. So this is what a FRA will allow me. The FRA will allow me to estimate a rate standing today, and at the 1 year time point, or at the FRA expiry as we call it technically, I'm going to compare my rate, FRA rate versus the actual prevailing rate in the market, and that decides what is the payoff on this FRA. So does the structure look okay? Was something like this discussed in your previous subjects?
No, sir, I don't recall it being discussed.
Okay, all right. But was forward contracts covered? So are you guys comfortable with forward contracts?
Yes, sir, yes, we covered the concept.
Okay. So ideas of cash and carry, reverse cash and carry, how do you price a forward contract, etc. Was that covered as well as a part of your earlier class or earlier subject? So maybe if you have equity forward, or maybe if you have a fixed income forward, or maybe even a FX forward, which is very popular in the market. So how do you handle or how do you price these contracts? So was this covered as well? So that basically relates with the idea of your basic time value of money being applied for your derivative pricing. So maybe what is a forward rate? How do you price the forward at initiation, at maturity, and sometime in between? So was that covered as well when forward contracts were covered in your earlier subjects? Or maybe how do you lock in cash and carry and reverse cash and carry?
Sir, I don't recall this one.
Okay,
Sir, I don't recall, and even if it was covered, if you could just, refresh it once, it would be really good.
okay. Because FRA is actually just a step ahead. Now, once we are comfortable with the ideas around forwards, it helps us relate with the ideas of FRAs as well. All right. So let's do this. So maybe we can do some recap on forward contracts and then we can come to FRAs. So let me look up something on forwards. I may have something on forwards. So were any numericals discussed as a part of any of your earlier subjects as to the pricing of this, or it was more of a theoretical discussion? So yeah, I think I'll just share screen. So forward contracts are like a forward commitment, I would say. Now, why we say a forward commitment? Because once I enter into a forward contract, I have to make good my side of the trade, and there's no way of exiting that, or no way I can actually back out. So that's why we call it as a forward commitment. So a forward contract. So first, the forward, is it a OTC or is it an exchange traded product? Which one of it is? Is it over the counter or
So
is
it's
it available on
OTC.
exchanges?
So OTC.
Correct, correct. Good. So it's an OTC product or over the counter. So that way you can customize your product. So the point on customization, which I have mentioned here. So a forward contract is something which you can customize. So that way it's a customized contract between two parties, which will allow the parties to buy or sell a certain asset at a certain point of time and at a certain pre-agreed price. So that is like an agreement which is done today. So you sign on a piece of agreement and then you wait until the delivery date for the forward or the expiry date for the forward, and at that time the asset gets exchanged. So that is what you call as a forward contract. Now the idea of long and short position. So again, the convention of long and short is exactly the same as we applied for other types of derivatives as well. So long basically is synonymous to buy and short is synonymous to a sell position. So similar things we can apply for the forward contracts as well. We have a long and a short position. Now, the buyer or the seller of the contract, now these are the two or three terms which are key, which explains the behavior of a forward contract. So firstly, there is a legal obligation. So that's why I say it's a commitment or it's a forward commitment. Now, whenever you have a forward commitment, it becomes an obligation for both sides of the both sides of the trade to meet to make good their commitments. So firstly, parties acquire a legal obligation to buy or sell a certain asset. The expiration date is fixed. That is, you know what is your time horizon for the forward. Also, at the same time, your delivery price is also fixed at initiation. So standing today, when I'm entering into a forward contract, these are the three things which are decided, and then the life of the forward contract begins. So, any questions on this? Okay. Now, idea of no arbitrage principle or no arbitrage pricing for forwards. So this will help us relate with cash and carry and reverse cash and carry subsequently. So firstly, meaning of a forward price. We also call this as a no arbitrage forward price many a times. So the simple equation can be just using the time value of money principles. FP can be S0 into 1 plus R bracket raised to T. So we can take a very simple example for a forward price. So maybe right now we can think of this as a non-dividend paying or maybe a non-dividend and non-coupon paying product. So a plain product will ignore any kind of uh, intermittent cash flows. Now, how to handle cash flows subsequently we'll see. But for understanding cash and carry and reverse cash and carry, we'll assume something like a ZCB or a zero coupon bond so that we don't have to worry about intermittent cash flows. It will help us understand things in a better way. So FP is what you call as the forward price or the no arbitrage forward price. And here you see this forward price is based on the spot price today, the interest rate which is prevalent, and we just relate this with the time to our time horizon or time to maturity. This helps us estimate what is the forward price. Now, forward prices can be quoted depending on the asset which you're looking at. So you can have a forward equity price or maybe a YTM, a FRA rate on, let's say, Libor or any other benchmark, etc. Now, how exactly we'll use this in practice and how we relate this with the arbitrage argument, that we'll see in a bit. Now, what is the value? So, would someone like to attempt this third point? So, what is the value to the long or short position at initiation of the forward contract? How much should be that value? Should it be 100 or anything else?
So maybe zero.
Exactly. It has to be zero. So at initiation, and no party should make money at the expense of the other. So that's why we say that this has to be zero. So at initiation, this is always zero. Now, for understanding no arbitrage pricing, we are going to use a few assumptions. So firstly, transaction costs are zero. Then there are no restrictions on short selling of products. Also, borrowing and lending can be done in unlimited amounts at the risk-free rate. So we'll make these three simplifying assumptions so that we are able to relate our forward price idea with the idea of no arbitrage pricing, which we call as cash and carry and reverse cash and carry. So general formula, this is fine. Now we can apply this to a simple example. Now we do a cash and carry discussion whenever the forward is overpriced, and we do a reverse cash and carry discussion whenever the forward is underpriced. So let's try a simple numerical so that we understand what this is. So let me just switch to my whiteboard. Now for simplicity, we are going to take a zero coupon bond so that I don't have to worry about any kind of intermittent payments or intermittent cash flows. So we keep the setup simple overall. So we are at 10 o'clock, right? So fine. So maybe we can complete cash and carry and then maybe take a break for 5 minutes and then come back. So I have a bond. Let's say the time to maturity is 3 months. Let's say the total face value is 1,000. Let's say currently it is at 500. And maybe the interest rate is 6%. Okay, and it's a ZCB, so I don't have to worry about intermittent payments. Now, as a very first step, let's say I want to calculate the forward price, FP. Now, I'll use the same formula which I've used earlier. So S0 into 1 plus R raised to T. So this will be 500 into 1 plus 6% raised to T. So T is basically 3 by 12. Yeah. So can someone help me figure out this, please? I mean, otherwise I'll do it in Excel, but can someone open Excel and solve this for me, please, so that we have a forward price?
Sir, 507.33.
Okay. So this becomes what I call as the forward price. Now imagine that this is like a benchmark price which I'll use for understanding both the cash and carry and reverse cash and carry logic, which is to follow, which is basically based on the idea of no arbitrage pricing. So we'll park this figure somewhere. So let me just write it here, and then I can just erase this step 1 so that I have the entire screen to use. Now, or maybe, I think the below portion should be good enough. We can complete the working. So we are trying to do the cash and carry arbitrage. The forward is overpriced. The forward is overpriced. Okay, now let's say, now we know this, that this is the forward price. Now imagine that there is a certain counterparty who wishes to transact on this forward contract with you, but let's say they would want to transact at a price of 510. Imagine. So they are quoting a price of 510. So they say that our FP, and we would want to do it at FP star of 510. So now there is a difference, isn't it? Now earlier we have calculated 507.33, which is based on our idea of no arbitrage price. But you have someone who is quoting a price of 510, now which is higher than our price of 507. Now from the arbitrage conditions, we know it's a buy low and a sell high logic. So you should always purchase something which is cheaper and sell something which is overpriced, or sell something which is expensive. So following the buy low and sell high logic, I can do a certain set of steps today, which is going to guarantee that I earn a certain profit at expiry. So let's understand what those steps are. So following the buy low and sell high idea. So today, what I do is now the forward is overpriced. So I need to take a short position in the forward. So that is short sell the forward. So when I say short sell the forward, that is basically an obligation to sell the bond in 3 months. So I'm shorting the forward. At the same time, what I do is I borrow $500 or 500 units, whichever you like. So maybe some currency units. So borrow $500. So maybe I can just put it as 500, or maybe I can just add dollars here. Borrow $500 from the bank. And now again, there will be a cost associated with this. So bank at 6% for 3 months, and use this money to buy the bond. That is, I am short in the derivative and I am long in the bond now. So I'm short selling the forward and I'm purchasing the bond. So shorting the derivative and longing the bond. So short the derivative market, long the cash market. So this is what I do today. Next, let's change color. Now in 3 months' time, the following things can happen. So firstly, my overall borrowing will increase. So I have borrowed 500 at 6%, right? So I can use this calculation which I already have. So my borrowing rises to 507.33, which is simply the same calculation, my simple time value of money. Also, in 3 months, my forward is expiring. So if my forward is expiring, naturally, I need to exercise my side of the trade, because I have to make good my side, and I am holding a short position. So I have to sell the bond. So in 3 months, I sell the bond at the pre-agreed price of 510, because this is the price which the party had agreed to, FP star. So I sell the bond at 510 because I already possess the bond, right? I have purchased the bond earlier. Now I sell the bond at 510, and my profit becomes 510 minus 507.33, because out of this 510, I need to return 507 to the bank. So whatever difference remains, roughly 2.3 or 2.6 units or $2.6, this becomes my arbitrage profit. And this is what we call as a cash and carry arbitrage. And this happens whenever a forward contract is overpriced. Now, any questions in this? So was something like this covered earlier? Okay. All right. So you can note down the steps, and we can wait a couple of minutes. So once you're done, let me know. Then we can proceed.
Yes, sir.
All done. Can we move ahead? Okay. Okay. So we are at maybe 10:30, 10, 12, 10:30. Okay. So should we take a break for 5 minutes? We come back and then we proceed. Would that be okay?
Okay, sir.
Yes.
Yes, sir.
Yes, sir.
Hi guys, can we resume?
Yes, yes, we're back.
Okay. So just one more part, and then we can start with Faraz. So we'll not get into discussion of pricing of equity forwards, etc. That is not really required right now, but something which you can definitely check out later on. But idea of arbitraging is important because that gets related with FRA pricing also. So we saw idea of cash and carry. Now there's something which we call as the reverse cash and carry as well. So I'll just erase this below portion so that I can do the working again. An idea of reverse cash and carry. This becomes whenever the forward is underpriced. Now let's say we have a certain counterparty which is willing to enter into the forward at a rate of, let's say, 502. Now again there is a difference, right? We have a no arbitrage forward price of 507, whereas the party is willing to enter into a trade at 502. So there is a difference. So again, whenever there is a difference from this no arbitrage price, there is a chance to lock in a certain profit, and that is something which we call as an arbitrage profit. So again, following the idea of buy low and sell high. Now something which is cheaper, you have to purchase. So here the forward is cheaper. So I should go long the forward contract. So something which I need to do today is long the forward contract. So when I say long the forward contract, that is basically an obligation to buy. Now again, this is just a piece of paper which you have to sign on. It's a legal agreement, but at the moment I don't need to exchange any cash flows. I have to just sign on the forward contract. Simultaneously, what I do is today I'll short sell the bond. Short sell the bond at 500 because that's the going price, right? So I'll this immediately results in a cash flow of $500, and I'll be investing this in the bank or investing in my account at 6% for 3 months. So two actions which I do today, I take a long position in the forward contract, which is obligation to buy, and I'll be short selling the bond at 500, and whatever proceeds I receive, that is the 500, I'll be investing at 6% for 3 months, which is the going rate. Now this is what I do today. Now in 3 months time, so in 3 months, my bank account balance will rise. So my account balance is equal to 507.33 because I have invested 500 at a rate of 6% for 3 months. So my balance rises to 507. Now, in 3 months' time, my forward contract is also expiring. So that way I have an obligation which has to be fulfilled. And that obligation is an obligation to buy. Now, so I fulfill my obligation, I purchase the bond. So I buy the bond at the price of 502, which was agreed upon as a part of the forward. So out of this 507.33, I use 507 in order to purchase the bond. So I buy the bond at this much and I will square off my short position. So once I do that, whatever remains after this 507.33 minus 502, which is roughly 5.3. So 507.33 minus 502 will be a profit of 5.33. So this becomes my arbitrage profit. So any questions on this? So technically also called as a reverse cash and carry arbitrage. Now, why these arbitrage relationships are important? Because that helps you understand that why no arbitrage pricing is important. And a similar idea gets applied in the idea of forward rates also, because finally, whatever implied forwards we are calculating, these are no arbitrage forwards, right? Because we are using the current spot rates which we have. So those spot rates are used to derive the implied forwards. So we are essentially using a similar idea. We are basically trying to use that no arbitrage relationship, and we are trying to estimate what is the best value for the implied forward. So something which will require for FRAs as well. So that's the reason why I did a quick recap of this cash and carry and reverse cash and carry, because this explains no arbitrage pricing in further detail. We have already covered some bit of no arbitrage pricing when we spoke about binomials and when we use the similar idea for Black-Scholes as well. So that way, the idea of no arbitrage will get used almost everywhere. So FRAs are also no different. They are also going to use a similar idea which we have discussed up till now. So any questions in this recap for forwards?
Question does not yet.
Yeah, Ali, you said something. Is it?
No, sir, I said no question.
Okay. So can we proceed? Can I switch screen and can we go to FRAs again?
Yeah.
Okay. Share screen. Yeah, is my screen visible? Because I got a prompt, can't share your screen or something like that.
No, sir, you're not sharing it yet. Okay, now it is. Now it is.
Oh, okay. Oh. So just proceeding with our discussion on FRAs. I think slightly different slide, but I think the idea is similar. Meaning of FRA is OTC is okay. Yeah. Now let's try to relate this FRA with. So maybe we can talk of the notation first, and then I'll relate this with point number 3. So just showing you the notation here. So something like maybe 1 cross 4 FRA. So first, the interpretation of this. Now this is the term for the FRA. And difference between this 4 minus 1 equal to 3 months is the life of the loan. So let me just explain this via simple timeline as well. So basically you can say 1 cross 4 is nothing but a 90-day rate 30 days from now. 30 days come from this first one, which is 1 month, and 90 days come from a difference between 4 and 1, which is 3 months, which is 90 days. So that's why we say this is a 90-day rate 30 days from now. Show it pictorially. Zero. 1 month. So this is my FRA initiation. This is FRA expiry. We'll explain this in terms of loan. I'll tell you why. It's easy to understand that way. So loan initiation and loan, or I would say loan maturity, whichever. One M. All right. So this is how I'd like to relate this notation 1 cross FRA or 1 cross 4 with the timeline notation. So I have 3 time points which I've given here: 0, 1 month, and 4 months. So 0 is the time where my FRA initiation happens. So this is the time where I enter into the FRA contract. That is, I decide on what would be the 90-day rate standing today. So standing on day 0, I want to estimate what is the 90-day rate 30 days from today. So that estimation happens here. This is also what you call as determining a FRA rate. In 1 month's time, my FRA expires, because that's how the notation goes, right? It's 1 cross 4. So in 1 month's time, my FRA expires, and then my loan period begins. Now, again, this is more of a hypothetical loan. It's not an actual loan which I'm exchanging. I have introduced this idea of loan so that it brings clarity to the way in which we are discussing FRAs. So that's why this idea of loan initiation has been done. So we can imagine that we have estimated a loan rate standing on time point 0. And once we move to time point 1 month, we are trying to compare our estimation versus the actual loan rate. That is, standing on day 0, I try to estimate what is the 90-day loan rate 30 days from now. And once I move to 1 month, I compare this earlier estimated rate with what is the actual rate for a 90-day loan standing on 1 month. And based on that comparison, I can interpret whether I have a chance to borrow at a below market rate, or will I have to borrow at a higher market rate. And that's why I would like to relate the idea of FRAs with an underlying loan. So loan is a hypothetical loan. We are not going to exchange the loan principal, but from an understanding perspective, relating it this way becomes easy. So any questions in this? Okay.
No, sir, clear.
Okay. So the link between FRA and loan and the notation method. Settlement is generally a cash settlement, and the cash settlement happens at FRA expiry. I won't say contract expiration. This can be confusing. So maybe I'll call it as FRA expiration. Contract is basically the FRA contract, but just to make it more explicit. So my cash settlement will happen at expiry of the FRA. So on this red cross, my settlement happens. Timeline notation we already saw. Also, creditworthiness of counterparties is not much of a problem. Now, this is not much of a problem because, as I mentioned, that we are not really exchanging actual loan amounts, right? Now, the loan is just a hypothetical loan which we have taken for our calculation purposes, because finally we have to estimate what is the MTM for the FRA. So, in reality, no loan is being exchanged. So, maybe my notional can be, let's say, $1 million. But at no point in time am I exchanging $1 million physically. That is, at no point in time $1 million will move from one party to the other. But simply to calculate the MTM, or what is the gain or loss on the FRA, to calculate the quantum of that, we require a certain notional, which we call as a loan notional of 1 million. Now, all that we are worried about is the interest rate differential. And when I say interest rate differential, it's the differential between my FRA rate of X% versus what is the actual realized rate at time point one month as Y%. And the difference between X% and Y% will determine whether I make money or lose money on the FRA. And how much is the quantum? It's this percentage difference into the notional, which will give me how much I make or lose on this FRA contract. And again, this is like a forward commitment. That is, I have to make good my side of the trade. It's not really an option. So it's not a contingent thing, but it's a commitment. So any questions? Is this okay? Okay. Now we can try to do some basic pricing and valuation for a FRA contract. So given a certain hypothetical example, we'll try and understand how to do these things. So we'll price the FRA at 3 points. The FRA at initiation at the time of entering into the FRA, then at FRA expiry, and sometime in between initiation and expiry. So these are the only 3 points where you have to price any contract of a FRA. So we'll see how that is done as well. So allow me to switch on my whiteboard, and I'll stay on my whiteboard for the remaining part of the class. It's not allowing me to share screen. Okay, guys, I'll do this. I'll just exit the meeting and I'll join back because it's not that screen sharing icon has become blurred. It's not allowing me to share screen. So just give me a minute. I'll log out and log in once. Sorry, I was on mute. Is my whiteboard visible now?
Yes, sir, it's visible.
Okay, all right, good. So now I'll be staying on the whiteboard. I won't need to switch again. So let's take an example to understand how do you price the FRA at initiation. So maybe we can take a same 1x4 FRA, which we had done earlier. That is 90-day loan, 30 days loan. Now let's say we have a certain underlying benchmark. So imagine that we have Libor rates which are given to us. So it's given that L30 is equal to, let's say, 4%. Let's say L120 is equal to, say, 5%. And now we have to estimate what should be the FRA rate. So basically, this is that rate which I need to estimate today, which I'll use for comparison purposes when I reach FRA expiry. So this is something which I'm doing on day 0. That is at t equal to 0. So this is something which we are doing right now at the time of entering into the trade. So the way to do that is, so firstly, are LIBOR, so the way in which interest rates are quoted in the market, are they annualized rates or are they unannualized rates? Any interest rate.
So they're annualized rates.
Correct. So every interest rate which you see in the market is always annualized. So that is like a convention. So unless mentioned otherwise, you can safely assume that it's an annualized quotation. But there are ways in which you can unannualize something as well. So we'll have to unannualize that rate because we are not really looking at the entire year, right? We are looking only at a fraction of the year. So we have 30 and 120 days to take care of. So that's why we look at only a fraction of the year. So we'll have to unannualize it. So as step one, I'll have to unannualize rates. So unannualizing rates, this can be done as, so my, let's say I call it as R30 is equal to 4% into 30 by 360. So I would require someone's help in this, and I'll do something similar for R120 as well, which will be 5% into 120 by 360. This one as well. So could someone give me both these numbers, please?
Sir,
Yeah.
R120 is 1.67.
1.7%. Okay. And the first one,
So the first one is 0.33.
okay, zero. Thank you. 0. All right. Now, once I've unannualized the rates, I can actually use these rates going ahead because now I'm looking at the required tenors which are of interest to me, 30 and 120. So now you would guess why I have taken 30 and 120. I have taken it directly for convenience because I'm looking at a 90-day differential, right? So I have something which expires in 30 days and a loan which begins from 30 up till 120. So that's why I have taken these rates for simplicity. In reality, you'll have an entire interest rate curve which is given to you, and you have to pick the required points based on your FRA contract. So that's why having clarity on the FRA notation is important. Now, if we don't have clarity on the FRA notation, we will not be able to figure out which tenor rates to look at. Because imagine the entire Libor curve given to you. And based on that, you have to decide which Libor points to take in your pricing engine. So that way, that clarity in notation is important. But for now, I have simply taken it as directly and no interpolation, etc. At times, you may have to go in for interpolation if a certain tenor quotation is not directly available. So maybe some form of interpolation might be required. Now, using the idea of no arbitraging, we have something like 1 plus L 120. I would say R120, not exactly L. So I'll relate this with the idea of implied forwards, which we have discussed earlier. That will be equal to 1 plus R30 into 1 plus R90. Now, this is similar to our idea of forward rates, which we had discussed in our previous week. So 1 plus, now R120 we already know. R30 also we know because that's the simply rates which you have unannualized, which we can use in the calculation. We are interested in R90. So this is something which we intend to calculate. So if I plug in the numbers here, and again, here I'll require someone's help in solving. So let me just simplify this. So R90 becomes 1 plus R120 upon 1 plus R30 whole bracket minus 1. That is 1 plus 1.67% upon 1 plus 0.33% minus 1. Yeah. Can someone help me solve this, please?
1.0075%.
Okay, 0075. Now again, this is still an unannualized number. Now finally, whatever quotation I make, it has to be in an annualized fashion. Now this is a 90-day unannualized rate. So in order to annualize this thing, I need to do a 360 by 90 so that I have an annualized quotation. So that way the market knows that it's an annualized number which I'm quoting. So can someone give me this value, please? So just basically 4 times of this number. Sorry.
4.03. So 4.03.
Okay. Is this 1.0075 correct? I'm slightly. So I'll also try that. I mean, this 1.0075 appears to be slightly different. So because by looking at the numbers, see the formula as well. 1 plus R 120, the unannualized one we have taken. Okay.
So the final number you are getting is 4.03. If you're doing the 360 over 90.
4.0. Okay. So everyone is getting 4.03, is it? I'll also just quickly double check. If everyone is also getting the same number, that's fine. I just want to see if that formula, I've also written it correctly. Appears to be correct, but still. I'm getting 5.34. Just share screen. So again, that sharing screen has vanished. But okay. Can you recheck your calculation because I'm not getting 4.03.
It should be less than 5.
Not really, because my multiple. So the ratio which I'm getting, so the bracketed term, the square bracketed term is coming out to be 1.0133. And then I just subtract 1, which makes it as 0.0133 and into 4, which is 5.34. So can I just ping those numbers in chat because that screen sharing, again, I think I need to just exit the meeting again and do it. So this is the bracketed term which I get. Then I just subtract a 1 from this and I multiply it by 4, which brings me to this number. So I'm not getting 4.03. So can someone quickly check once again, please? And ensure you have taken percentages so that our number should tally. So once someone checks, we can just replace this. So let me share screen if I can. I'll just stop sharing. Let me see if it screen sharing has vanished. So let me just exit into user. So let me share Excel.
Sir, just
Yes.
a question I want to ask you: where is it that you feel that the numbers are getting changed up compared to?
So here, so if you see my screen here,
So
I've
could
done
you
a
zoom in
simple
by two
calculation.
levels on the bottom right?
Yes, yes.
Thank you, sir.
So these are the two numbers, 1.67 and
0.33.
0.3. Then I do a 1 plus this thing, 1 plus the numbers.
Oh, okay, sir. Okay, sir. I am so sorry. We made a mistake. We added.
I think the percentages
Yes,
might
sir. Yes,
be
sir. I'm so sorry.
thought so.
Yeah.
No
We'll.
problem, no
Yeah.
problem, no problem. So we can take 5.34, something which I pinged in the chat. Hopefully screen sharing is working correctly now. Good, good. It's allowing me to share. Fine. Okay. So I just replace this by, so what was that number? 5.34.
Sir, I'm so sorry. Could you please show your Excel sheet one more time?
Yes, yes. Second column, you can ignore, this won't be required. Simply taken that, I mean, Excel is intelligent enough, it will directly handle those percentages directly with decimals. And then just a simple ratio. And minus 1 into 4. Yeah, looks okay?
Oh, all right, sir. Yeah.
Okay.
If you could just give us 1 minute so we can just like.
Yeah, of course, no problem. Yes, yes. So generally, even if you don't convert into decimals, it's fine. Excel converts that percentage while it handles that. So that way, you can just write it as it is, and you don't have to write it as 0.0167. Once everyone gets this, let me know. Then we can proceed.
Sir,
Yeah.
sir, two questions. First one is, why are we making it annualized?
Because finally, whatever quotation you are going to quote to the market, it has to be in an annualized fashion.
Okay. And the second one is, sir, I still doubt that it should be between 4 and 5 because we are calculating 90 days period.
Okay. But if you see the numbers, I mean, the plain calculation which you have done. So that way, we haven't really gone wrong anywhere. You just taken a simple ratio, subtracted 1, and you just analyze that. So don't worry about the numbers now. I mean, approach is something which is more important. Subsequently, you can try it out on some other number as well. That should be fine. But approach is something which we'll focus on right now.
Yes.
So can I go back? Can I go to the whiteboard? Okay. So 5.34. So this is what I call as the pricing of the FRA. Now, this is the rate which I freeze on today. So that is standing today at the FRA initiation date. I say that this is my estimation as to what will be the rate on a 90-day loan 30 days from today. So we are going to use this number for the next two parts. Now this is part A, right, which is pricing of the contract. Now the next two parts is pricing of the FRA at expiry. That is at the expiry of the FRA, and second is sometime between expiry and today, or between expiry and initiation. So for the next two parts, B and C, we are going to require this 5.34 number which we have calculated. So this you can imagine as the FRA rate, which is going to be used subsequently. So I'll also just maybe I'll make a note of this here, so that once I erase that, I'll still have it for reference. So can I erase this much? Should we try part B? So maybe pricing the FRA at its expiry.
Yes.
Okay.
Sir, I'm so sorry. Could you please undo that for 1 second?
Yes. Yeah.
Thank you, sir.
Oh.
Done, sir.
Okay. Can I do? Yeah. Okay. Okay. This is part B. So pricing of the FRA at FRA expiry. So expiry is going to happen in 30 days time. So imagine that I am on that 30 days now. So I know what is the actual loan rate now, because since I'm standing on day 30, I know what is the 90-day loan rate starting today. So that way I have something for comparison. I already have 5.34, which was my contracted rate. Now 5.34 is something which I can compare with what is the going rate in the market. So that is something which we can do now. Now let's take a hypothetical notional. So let's say notional is $1 million. And let's say the actual 90-day rate is 6%. Imagine. So let's say this is the realized rate, that is standing on day 30. I know that for a 90-day loan starting today, it is going to be 6%. So this is the market quoted rate. So now, assuming that I am holding a long position in the FRA, will I benefit or will I lose because of this? What do you feel?
So benefit.
Correct. We will benefit because the thing is, our FRA rate is lower, right? It is just 5.34 versus 6%. Now we have a chance to borrow at a below market rate, which is the difference between these two. So it's a benefit for me. Now, because I'm holding a FRA contract, I have a right to borrow it at a below market rate, and that's why I make money. Now, if this was 4%, let's say actual rate turned out to be 4%, I'll lose money because then I'll have to borrow at a above market rate. Now, market is willing to give the loan at 4%, but because I have struck a a FRA contract, I'm stuck with this rate of 5.34. So that would have been a loss for me. But in current scenario, it's profit. So let's calculate the amount of profit which we are going to do. So as step 1, I can calculate interest savings. And this is the difference between 6 and 5.34. So I can write this as, again, I'll need to unannualize this because it's a 90-day thing. So actually you can keep 90 by 360 common outside as well. That should be fine. I wrote it twice, but you might want to keep it outside and just take the plain difference. Now, can someone help
So
me with this
first
number?
number is
6% minus
1.25.
5.34 unannualized into 1 million. Okay, you can actually give me the direct value. That should be fine. The overall bracket into 1 million. So it should be few thousand, maybe lower values of thousands, because that way we have this decimal and again we have a fraction as well.
So 0.1657 percentage of 1 million.
Okay, so can you give that product as well? So maybe can you multiply it by 1 million and give
Yes,
me
so
the
just give
exact
me
number?
a minute.
Yeah. So basically into 10 raised to 6. So it will be 1000 something, or so since it's something like 1600 types, then it will be around, I think, around 1700 or something, if that's the number quoted.
So 1675.
Okay. Okay. So this is the amount of interest savings which I'm calculating because I'm holding a long position in this FRA. Now, long position. Now, so will this be the answer, or do I need to do anything else after this as well? So if someone tells me that, can you tell me what is the pricing of the FRA at expiry? Can I say it is 1675? Or will I need to do something more on top of this in order to get to the answer? So one more step. So can you guess what that one more step can be? Just one step and my job is done. So I need to discount this as well, right? Because these are like my loan savings. So 0, 1M and 4M. Now, whatever this 1675 which I'm calculating, this is due at the 4-month time point, isn't it? Because this is my savings, and whatever exchange has to happen, that will be at the end of the loan period. So 1675 is due only after 4 months. I have to bring it back to today because I'm standing on this point. I need to know how much this is worth today. So I need to apply a discount factor in order to bring it back to today, so that I know what is the FRA price on 1 month time point. Is this okay? Okay. So MTM at FRA expiration, which we are trying to calculate. This is 1675 upon the discount factor. And take the unannualized quotation. Because 6% is the given rate as of now. So I take the given 90-day rate. And can someone help me with this number? I can also do that in parallel. I have my Excel open.
So 1650.24.
Now, this is what you can call as the MTM. So if you are to mark it on the financial statements as to what is the MTM valuation for this product, you can use 1650. So now this number can be used for your MIS reporting, audit reporting, and also any kind of exposure monitoring, etc. So this is how you calculate the FRA price at expiry. So again, now this is something which will happen just once in a life of a FRA because expiry can happen only on one date. The third scenario is when you're trying to price a FRA sometime in between. So between today and, so when I say today, from FRA initiation up till FRA expiry. So that will be stage 3. So once you note this down, let me know. Then we'll do just one small working and then we can stop for today. Because it's good to complete in continuation because we anyways done A and B. So we can complete part C also and that will be the end of FRA. Or we'll complete majority of the FRA part. So relevance of FRAs, where exactly it gets used, etc. we'll see when we meet on Monday. But at least we can get the calculation out of the way. So can I switch? Can I go to part C? All right, so going to part C now. So part C is pricing the FRA in between. Between initiation and expiry. Please ignore the spelling mistake, but it's initiation and expiry. Now imagine that I have entered into the FRA 10 days back. So let's say 10 days have passed since I have signed the contract. So it's given that 10 days have passed since contract initiation. That is, so if 10 days are done, it's a 1 cross 4, right? So 20 days remain for FRA expiry. this is given to me. So 10 days have gone. I have entered into the contract 10 days back. I'm standing somewhere in between. Now, I want to know how much is the worth of this FRA today, because I'll have to mark it on my statements as well as I have to prepare it as a part of my exposure reports, limits monitoring, risk calculations, etc. So also let's take some information again. Now again, notional we'll take the same 1 million, and let's say the current Libor structure which is available for us is we have R110, which is 10-day Libor, let's say close to 6%, so 5.9%, and maybe a 20-day Libor is something like a 5.7%. So let's say this is the market information which is given to me. So I have this information, 10 days have passed, and next information is contract specific, which is 1 million notional, and these two, R110 and R20, that is something which comes from the market. So maybe I can highlight them as yellow because these are my inputs. So as per Excel convention, this becomes my market input. N is given to me, and now I need to understand what is the MTM for the FRA standing on day number 10. So let's see how that is done. So just a couple of steps. So again, as a very first step, I need to calculate what is the new FRA rate. So this is also what you call as repricing of the FRA technically. So new FRA rate, or technically called as repricing of the FRA. So this is the step 1. So now I'm standing on day 10. So now 110 and 120 become my relevant rate. So that's why I've directly taken them, 110 and 120, because I can use them directly in the calculation, because I still need to look at that 90-day window in between, right? So that 90-day window is again maintained here because we have 110 days and 20 days. So if I simply take a difference, I still end up with that 90-day window which I require, because I am interested in the 90-day loan, isn't it? So following the same logic here, again, if I just eat up a few steps and so something which you have done in part A, I'm doing it here. Only thing is I'm just eating up a couple of steps and writing the formula directly. Okay. Put brackets around this. This thing -1 into the annualized potential 365. So that is, if I had to just write it here. So maybe I'll write it above because I need this below space for the next steps. So I'll just change the ink so that it becomes easy to track. So 1 plus, you can just unannualize these bits. So I'm just expanding this bracket. You can do this calculation subsequently as well. It's not a problem, but I'll just write it here so that you know exactly what is happening. So just solving this, and I have unanalyzed the numbers here itself. Earlier in step A, we had done this separately. So I've just combined those two steps together and I've written it here. We write the unanalyzed form here. We subtract this 1, etc., which is, again, we are following the same idea of implied forwards, which we have done. And then we have an annualizing factor of 360 by 90. So by solving this, you can solve this subsequently. We can write this, maybe we can give a certain placeholder as maybe X. So later on, you can solve for this. We'll do the next 2 steps. Now, I have to calculate what are my interest savings on the FRA. Calculating savings on the FRA. So to calculate savings, I need to compare this X% versus 5.34. So this X% is something which you can replace subsequently, but I'll tell you what is to be done so that you can do it later in your time.
So this is 5.92%.
Okay, excellent. Thank you so much. I'll write it as 5.92. Excellent. So 5.92 is something which we have to compare against 5.34, which was calculated earlier. So savings on my FRA will be 5.92. Again, I'll use the similar format which I did the last time. So rather than writing 90 by 360 outside, I'll write it inside so that it becomes easy to understand the savings calculation, which we had done in part B. You can again just take it as common and keep 90 by 360 once outside rather than writing it in brackets. But to maintain consistency, I'm writing it this way. So this will come out to be something. So if someone could help me with this number, and there'll be one final step. This number upon the discount factor. So I need, and now it's still 110 days away, right? So I need 5.9% into 110 by 360. So the number which you give me, I'll just write it in the numerator here.
Yes.
So 1450. So
That's the final answer, is it?
Second step.
Okay, 1450. All right. And can I request you to do just one more step more? So 1450 upon this discount factor.
So 1424.32.
Maybe I can just round it off. Okay, so maybe I can just round it off to 1420. All right, so great. So this becomes the MTM for the FRA at day number 10. So tomorrow, once you move to, let's say, day 11, day 12, day 13, you'll have a new Libor term structure which is available. So you'll accordingly have new values for these rates, which I have highlighted in yellow. So accordingly, your repriced FRA number will change, which will again have to be compared with 5.34. This remains consistent. This will not change because this was done at initiation, right? So we have frozen onto this rate. But this 5.92, which we calculated, will keep on changing based on how the Libor term structure is moving as well. And subsequently, I'll get a new FRA MTM on a daily basis. So again, this calculation can be automated. So it can be something which happens on a daily basis because it will be required from a regulatory and management's perspective. We need to know what is the value for every asset in the portfolio on a day-to-day basis. So as a part of your daily portfolio valuation, these calculations will happen. Now, these calculations will be there as a part of your calculator or as a part of your enterprise risk system. But it's always good to know what goes on behind those calculations because if you have to justify that calculation to a client, or maybe if a regulator comes up with a question saying that, can you explain what has been done in your Calypso or a Murex system? Or maybe if you are to enhance the calculation in some way. So your boss says that, and there's a slight change in convention which is done. So rather than doing a 360, we want you to do a 365 now. So at that time, where exactly to change what, etc., that is something which on which you should have complete clarity. So that's why having an idea of these calculations is useful. So any questions in part A, part B, or part C? And these are the only 3 points whereby you'll have to price a FRA.
So I have a question. So while calculating MTM, we are using FV divided by 1 plus R. So why not we using FV divided by 1 plus R to the power T?
So here we are using the term structure, or here we are basically using the zero rates which are available. So imagine that the rates which we are available to us, they are like zero rates which we are using. And when we do that, when we have to unannualize that rate, something like a zero rate which is available, we have to unannualize. We can unannualize it in this way and use it, and that's why we did a 1 plus RT. So although I say Libor, you can imagine that these are like my, it's like my spot rate curve which is available for me. So right now we haven't really bothered about the bootstrapping bit, but you need to bootstrap your incoming Libor rates and then use it in your FRA calculation. That's why when I mentioned about Libor term structure. So generally we are talking about the zero rates or spot rates which have been derived. So I'll take the attendance quickly. So Akash is present. So this is financial economics first. Achal Jain.
Present, sir.
Ayush is present. Adesha. Tejas Aquaric. Ali is present. Anjali Garg. Anmol Sen. Arismita Dekar. Avni Mishra. Ayushi is present. Sarvish. Bhavya Dan. Harry Chabra is present. Diksha Chauhan is present. Dipansha Singh is present. Gaurav Kadam is present. Gaurav Datir is absent.
Present, sir.
Gaurav Kadam is there. Gaurav Datir is also there, is it?
Yes, sir.
Okay. My apologies. Sorry. Himanshi Verma is present. Jaideep is present. K. Ayushi.
Present, sir.
Okay. Riya Shukla.
Present, sir.
Okay. Kriti Marwa is present. Mansi Singhal is present.
Sir, she is also present. She has a mic issue.
Okay. Mansibaran Arora.
Present, sir.
Okay. Manvi Kukreja is present. Mihir is present. No, Mihir is absent. Muskan Garg. Namrata Gaur.
Present, sir.
Okay. Neil is present. Nikhil Agarwal. Prasun Sharma. Pratik Maheshwari.
Present, sir.
Rachit Tyagi. Rahul Ghosh. Rahul Giri. Rahul Goswami. Rajaditya is present. Ashish Jain is present. Rishabh Kothari. Ruma Keshri is present. Sahaj Manocha. Samiksha Chopra. Charanya is present. Shubham Jain is present. Shubham Kumar. Someshwar Verma. Mehrotra is present. Sanika Thakur is present. Vinay Pawar. All right. So
Sir,
economics class is done. So guys, if you have
I
another
think
couple-
FE, I think Rishabh was present in FE. I think he just left.
Okay. So that's Rishabh Kothari. Okay. I'll mark it. All right. Okay. So FE is done. So if you guys have a separate session after this, you guys can leave. I'll take the attendance for IB and then we'll stop for today. So I look forward to meeting you on Wednesday. And we'll talk a bit about applications of FRAs and then we can start something new. So maybe we can do some hands-on on Wednesday. So request you to maybe browse a few things on VBA and we can try to do some simple hands-on bit. Yeah. So Ayush Sharma is present. Alisha Gupta. Vidhi. Anant Jain. Anish Dopeshwarkar. Anjali Sethi is present.
Present.
Arshada Imam.
Yes, sir.
Okay. Barka Israni. Bhavya Patel. Saloni. Chaitra Tirodkar. Devam Pandey.
Present, sir.
Diksha Kalra. Gauraja is present. Gayatri Narkhede. Govind Mittal. Savan Hake.
Present, sir.
Okay. Himanshi Virmani is present. Then we have Hindu, Ishita Saxena, Kanika Goyal, Karthik Mittal, Kasroel. Lakshay is present.
Present, sir.
Mahi Rajawat, Mansi Gupta, Matagi Warrior, Megha Parak, Nancy Alawat, Neha Jain. So if I'm just reading out these names, if anyone is present, please let me know. Otherwise, I'm marking them as absent. Pratishta Pradhan, Rohan Bagai, Rohit Potar, Samita Malik, Shivangi Simwal. Simran is present. Srishti Verma, Anu Goyal, Tarang Kadyan, Kalyani Tolkari, Twinkle Karnawat, Vaishnavi, Manishka Jain. Libor, Vidushi Rana is present. Yash Mehra. Yeah, Yash Mehra. All right. Yeah. Thank you so much. Thanks for joining in, and I'll see you on Wednesday.
Thank you, sir.